What is happening, SMB Nation? It is your boy here, TV at SMB, coming at you today. It's Tuesday. Market has been slow, turtle pace today on the market. We have terrible price action today. I mean, market just been going sideways, up and down, chopping around. Some nice consolidation for the bulls. It's not bearish whatsoever. If it's never bearish if things just don't keep going straight up. It's bullish if we go up and then we go sideways and then we go up again. That's very bullish. You like to see consolidation, so that's exactly what's happening today. No reason. I'm not saying get puts or nothing. We are just seeing a little choppy chop action after the market has basically gone straight up for the past week or so. So to be expected. We also have those Microsoft earnings coming out today, which the market, I imagine, is waiting on those. But I want to start things off with a little bit of a message. We're going to be talking about the FOMO today, and I know everyone loves the FOMO. FOMO feels so anxiety inducing. You hate it. It's just like you don't know what's going to happen, but you think things are going to go up because that's just what things do, right? So first, we're going to start off with a little tweet here. My screen is too big. You couldn't see it. Michael Burry, the famous bear. We know this guy. They made a friggin' movie about him. He likes to go short. He tweeted this out yesterday, and it got me a little interested, and I was like, what's this guy going on about? So, in trading, there is a common strategy kind of known as the golden cross or the death cross when it goes the other way. Death cross obviously bad, golden is good. And that would be the 50 simple moving average when it crosses up or when it crosses above or below the 200-day moving average. You can typically make a assumption about where the market is headed. And now, why is this important? Well, I'll show you a little example. So let's go back to present time. So on my chart, this is the XPX chart, daily chart. My green line is that 50 simple moving average. The yellow line is the 200-day moving average. You can see right where that crosses below it back here in March. That a lot of people were talking about that. They were like, oh, dear God, we are dying here. Things are not going to be going good. And then what did the market do? It rallied. So we had a big FOMO rally back in March. I know you people remember it because I remember it vividly. I got destroyed by it. SPY just went straight up, and then it topped out, and then we came crashing down. Well, if you just went short and bought long-dated puts on this crossover when this crossed below it, you obviously made a killing. And why is this so important? Because, well, if you look over here on the daily, we are about to see that cross. We have our green line about to go over that yellow line. I know it's very simplistic. It almost seems too simple. And it isn't just like a end-all be-all strategy. It is just a very it's an affirmative strategy. If you're bearish and you see that cross to the downside, it affirms your opinion. If you're bullish and you see it cross to the upside, it affirms that position as well. And we are right about to cross from that. I mean, those lines are literally like 0.5% away from each other on the SPX index, on the S&P 500 index. So Michael Burry tweets this out because this is a chart from, if you look at the bottom of the chart, you'll notice 2001, 2002. And that is definitely the recession that this current one that we are in has been compared to the most, that in the 80s, because they were both kind of had to do a lot with inflation. 2000 really because it was such a massive tech bubble like we are still currently in right now. That bubble is still not burst, believe it or not. The Nasdaq going down 30% is not a bubble burst, let me tell you, because we're going to look at 2000, and that's a real bubble burst, baby. We're going to talk about that. But Michael Burry tweeted this out, and as you can see, he has his simple moving average. 50 moving average is pink up here. The yellow is a 200-day. Wow, he used the same color as I do. How about that? And back here in 2000, or what is this? Yeah, this is 2002. This would be about April of 2002. We had these lines just tap each other. They just did a little tappy tap on each other. And he has that circled over here. This is a big old FOMO rally that happened back in 2001. These lines just barely tapped each other, and then they resisted. And then what happened? Oh no, the S&P, it fell from about 1180 straight down to 800. A massive, colossal dump after a huge, massive FOMO rally. So if we look at my daily chart here, let's zoom out and go way back over to 2001. Way over here. Almost there. All right. So this is what I'm talking about here. This is the S&P 500 back in the year is 2000. We peak up here in March of 2000, and that is the last time we'll see 1500 on the S&P index until clear over here in August, or what is this, July of 2007. So it took 7 years to recover those highs. We get this dump. We get the peak in March, and then what's important here is what I've been talking about this entire time. We get these crazy rallies, and now this is what I mean by bear markets are so hard to trade. They're so hard to take any kind of long-term position in because they can be so volatile. We get these crazy rallies, 14% rally on the S&P 500. Lower high, look at that. Dump, we get a nice rally. Look at that, lower high. Dump, we get a big rally. And I mean, this just went on and on and on for like 3 years. We get a 10% rally, lower high. We get a massive, massive dump from here. We go straight down. 22% from this peak. We dropped 22%, I believe, right? Yeah, 22%, right? Let me see. Let me make sure. Yeah, we dropped about 22%, and then we bounced 22%. But what do? Make a lower high. And then guess what comes next? Another lower low. We dropped 28%. So you're seeing the trend here. We make a lower high, and then we dump even more than we rallied. All right, so what is he talking about? Exactly where is he talking about? All right, we see this massive dump. And now look at this on the S&P 500. This looks like capitulation, like panic selling, like this is the bottom. We have bottomed because you see this dump, this high volume dump back here. Now this is 9/11, mind you. This was the week that 9/11 happened. They didn't have the stock market open for the rest of that week. 9/11 was on a Tuesday. They keep it closed for the next 3 days. What happens next week? The market opens up and it's panic selling. The market just dumps on Monday. It drops 5%, 0.5% after that, 3% next day, another 2%. And then next week, we get big old panic buying. People are buy. What's the big deal? Why does 9/11 affect the stock market, you know? So we get a crazy bounce. People are buying. This looks like a bottom. Wouldn't this look like a bottom? Huh? Wouldn't you see this drop? We've dropped from 1,500 straight to 950. That is a 40% drop. Almost exactly 40%. Wouldn't you be like, wow, about 40% sounds about right. And we're getting a lot of buying. I better FOMO in right now, right? Well, if you were smart, you would have been patient and waited to see, well, wait a second. Are we going to get above that last high? And sure enough, no, we do not. We triple top at 1176, lower high. And then what happens? Oh, my goodness. We dump another 35% from that point. And now, why is Michael Burry talking about this exactly? Well, if you've noticed my yellow line right there, look at that green line. We almost got that cross. It almost happened. And now this was back when FOMO was at its peak. I mean, inflation was low here. They were dropping interest rates by this point. If you look at the Fed funds rate, they'd started dropping interest rates at this point. Now, mind you, they had interest rates at like 5% way up here. This was back when they were so afraid of inflation at like 2.5% that they jacked up interest rates because of inflation that low. Like, that's how mindful of inflation they used to be. They are no longer like that. Now inflation is like, well, if it's at 4%, that's good, right? Like, that's basically where the Fed is at this point. It's absolutely bonkers. But this is where they started dropping rates. They start cutting rates. If we look at the Fed funds rate, effective Fed funds rate, let's see where this goes. Effective Fed funds. Oh, we got to go way over here to early 2000s. They start dropping rates at the end of 2000. End of the year 2000, they go from 6.5%, which is still higher than we are right now, from 6.5% straight down over a year to about 1.73%. They're cutting rates, and then they keep cutting rates. They go sideways a little bit. They drop them again, drop them almost to basically 1%. And if we look at what the market was doing, so they start dropping rates at the end of 2000. Let's go. God, I wish I could just go straight over here. They start dropping rates at the end of 2000. Everyone's like, all right, that's the pivot, right? This is it. And what happens? We get a nice rally in January. Oh, but then the market still keeps going down. Oh, no, we drop another 20%. But wait, they're dropping rates. Oh, so we're going to rally 20%. But hey, they're still dropping rates throughout 2001. But oh my God, we're going to drop another 30%. And then 9/11 happens. And then, all right, they're dropping rates. Inflation's getting lower. Things are good, right? We go from September till about May. September 01 till about May 2002, and then we start dumping again. We get 9 months of what looks like the bottom of the market, Everything's good and dandy. And then we just fall off a freaking cliff into the summer of 2002. And then that isn't even the lowest. We still get another, here we go again, another FOMO rally. Another FOMO rally. 25% on the S&P 500, only to drop and make another low. So this is why he's tweeting about this, because it is so... we're in such a microcosm. People think the stock market, like a year in the stock market, is a long time, and it's really not a long time at all, especially for economic cycles. Like 1 year recessions are unheard of. They don't happen. So this is why I look at the past, because this is all we have to go off of. I look at the past because this isn't the first time. I mean, you would think, oh, the stock market's different than it was back then. It's more volatile. And it's like, not at all. This isn't even tech. Tech was way less weighted back here in the S&P 500 than it is right now. Tech is way overweighted in the S&P. It's the heaviest thing in the S&P right now, I think, right? But then the Nasdaq is obviously all tech. I mean, if we look at the Nasdaq, it was even worse back here. It's not even close. The Nasdaq went down like 80%, man. I mean, yeah, it was sad. But this was like back in the early days of tech. Things were a little different. But same thing. Nasdaq did the exact same things. We'd still get these crazy 60% rallies on the Nasdaq. Come over here, 2001, we get another 55% rally. Over here, we get another 60% rally. And then what happens every time? Oh, we fall further than we rallied. Every time. Every time it just kept falling, finally bottoming in the end of 2002. And then, of course, the Nasdaq would not see these levels at 118 until about 13 years later. Anyways, so this is what I'm talking about, why it feels like people are so like zoomed in on their charts. They don't look back at history. They don't look back at what the stock market is capable of. They are just so zoomed in. And that's why these indicators matter. That's why these are important, because if you would have just waited for this cross and it never happened, you wouldn't have FOMO'd into this stupid rally. You would not have done that, because people were buying. I mean, of course, people were buying the dip. It's like, now we've bottomed, right? Now it's time to buy the dip, buy the dip, buy the dip. But if you zoom out, you would have seen, hey, we still made a lower high. So where does the trend break, you might be asking? And clearly it's over here. Finally, we get a bottom. So if you look here, we have our lower low. We finally get lower high, followed by a higher low, lower high. Then we get that higher low, finally. The market, so it has these just crash after crash after crash, where it crashes 15% again, just left and right. And we finally get a higher low. And then what's that followed by? We go straight up here to a nice higher high. We get a 30% rally, and finally we have our higher high. And then what happens? We get a pullback with a higher low. It is supported by that past high over here. You can see that right at 957. Look at this nice little line. Look at that right there. You can see that. Why is my camera so far off my face? And then finally, we get that. You pull back, and then what happens? So I know the FOMO people are like, well, you missed all this downside. Well, people over here were saying, oh, no, you missed all this downside. Then what happened? Next downside. Oh, we're rallying, but you missed buying. You could have bought the S&P at 960, but you missed out. Now your chance is gone. Well, only about 9 months later, you'd have a chance to get in at 15% cheaper. So once we got our confirmation of our uptrend, we get a bounce. Say you buy right here. What's the market do? The market goes just straight up. I mean, this is right here, August of 2003. About 18 months later, right? 17 months later, back here in March. Over here in March of 05. We got a nice 26% rally. And every time along the way, you just keep buying the dip. So here we go. You get a dip from right here. You dip down 6%. Boom, you buy a dip there. Climb up 5% from there. Boom, you buy another dip there. You climb up another one. Boom, you buy another dip there. So you accumulate on the dips, therefore increasing your position each time you're dipping, because this is buy the dip market. We're in the uptrend. We keep just getting higher highs, higher lows, higher highs, higher lows, big rallies, and you keep accumulating. That's why you don't FOMO. That's why no one is like looking at this chart and being like, I need to nail the exact bottom, because once we're in that uptrend, you get moments, opportunities to buy. You get the dips. You start buying the dips. So that's why you should not be feeling the FOMO that you missed out on 20% of something. Oh, God, I missed out on 20%. I mean, this is even worse if you look at stocks like NVIDIA. I mean, this is just mind-boggling. You look at NVIDIA, and it's like, yeah, NVIDIA rallied right here. It rallied 150%. Sure, that's fine and dandy. Oh, then it crashes again. It drops another like 80%. Oh, you were thinking back here, well, I wish I bought NVIDIA. I'm never going to have a chance to get back into NVIDIA. Of course, this was a completely different market. I mean, back here, NVIDIA is almost like a penny stock. Or I think it was higher because they were doing splits back here. Yeah, all these stocks are doing 2-to-1 splits. It's so crazy. AMD, same idea. I mean, it's just not even funny. And no investor, you never say, well, this time is different. This time is different. You don't say that as an investor. Same thing back here in AMD. Look at this. Look at this year. Imagine this year at AMD. So say AMD's up here at 47.80. What's it do? We dump down 72%. And say you didn't buy this. You're seeing this and you're like, oh my God, AMD rallied 157%. I have to buy some. I missed the train. This was my opportunity to get on AMD. Oh, so you FOMO'd in up here at 30 bucks, I bet, right? Because you're like, I missed it. This is the cheapest time we're going to see AMD. Everyone's talking about .com. Everyone's talking about how big semiconductors are going to be in the future. Sure, I should buy now. Why does it matter? It's going to be a good stock. And then what happens? It goes to 35. It dumps another almost 80%. So then, oh boy, here we go again. Oh my God, another 170% rally on AMD. And now, mind you, these are very tradable rallies. Yes, you want to trade these rallies, but these are not times where you just buy and hold things. I mean, they can be if your time horizon is like 10 years on AMD, which, by the way, AMD peaks here at $49 back in May of 2002. It doesn't go back to 49 bucks until way the hell over here. Oh no, it goes back to 40. No, it doesn't even get close to that. It don't go back to 49. That was a peak, right? God, that's shocking. 48.37. It doesn't get back to that price until way over here in February of 2020. Yeah, I know it. How crazy is that? Now, yes, AMD is a different stock, but I'm just saying this is possible. This is very possible, and this is why it's so hard to pick stocks, because you don't know which stock is going to do this. But it's like, it's same idea. Same idea. You get these insane rallies. You're FOMO'd. You're like, there's my chance. It's gone. But sometimes you'll just get another chance. And how do you know if you're going to get another chance? Well, you just wait and see, because if you just waited on AMD, you would have noticed, hey, there's the high, there's another high, there's a lower high, here's a lower high, here's a lower high, here's a lower high. And then finally, what do we get? We get a higher high. And then, oh, well, you're like, well, I missed my chance. I'll buy up here. Well, then if you just waited about 6 months, you wait and AMD comes down 42%. You get a chance to buy AMD. This is back in the bull cycle, mind you. So this is what I'm talking about. We are so zoomed in on this 1 year, so zoomed in. We look at NVIDIA and we go, oh my God, NVIDIA, it has rallied so much. I missed my opportunity to buy NVIDIA. If I would have bought NVIDIA at the exact bottom, which literally no one ever times the exact bottom, I'd be up 80% on that position. And you think, all right, well, now that it's up here, it's up 80%. I should buy right now, right? Now I should buy. That's like the epitome of dumb money. It's the dumbest imaginable thing you could do right now. Maybe I should buy NVIDIA right now. Well, you still got to look at NVIDIA, and it's still making... We did get a higher high above this one, which is pretty bullish, but it's still in this downtrend. There's going to be dips. NVIDIA is very volatile. There's always dips. Even back here in 2020, we were getting big old dump-offs in NVIDIA. We'd see NVIDIA dump 10% here, dump another 10% over here. There's always big dips. I'm trying to avoid everyone from getting bull-trapped here. That's the moral of this story, is that just because we had 1 year of pain doesn't mean that now it has to end. The Fed is still jacking up rates. Tech is still getting hammered. They're laying people off, which, yeah, now it's a temporary good, but then what happens if they're not making as much money as they were making even after they laid those people off? Things can just change so quickly. Things can literally change over the span of 2 days, like extremely quickly. That's why trading is so difficult, because it's hard to get yourself the will and the courage to buy something, but then have the ability to just completely change your mind over the span of 24 hours and be like, nah, I should sell that. I was wrong. It's so incredibly hard to do that. But this is what I mean. I'm not saying that we're going to be in as much pain as we were back in 2002. I don't know. All I do know is that the S&P has been making lower highs every time. That's all I know. And every time it makes a lower high, it tends to make a lower low. That's all I know. And you could say this stock market's different. I disagree. There's a lot more dumb money. If anything, there's a lot more dumb money in the market over now than there was back here. You couldn't just whip up your computer and open Thinkorswim and buy a SPY call back here. You couldn't even do that back in 2008. So there's a lot more dumb money, a lot more dumb liquidity in the market that is buying into these FOMO rallies right now. People are buying this FOMO rally. SPY at 400. This is the last time I'll see SPY below 400, I bet. I'll never see SPY below 400. Well, yeah, we'll see about that. We will see about that. Honestly, we're going to see about that. And then when you really zoom out on this chart, I mean, it really puts into perspective how insignificant this pullback has been. I mean, you look at the history of the S&P 500, you look at real recessions, that's the pullback. That was it. That was the recession. Really? That was the worst recession. Really? That's a bad inflationary recession with the most aggressive Fed in 40 years. This is what we got. Are you serious? Are you serious right now? Bro, come on, bro. You cannot be that gullible, man. And now, I'm not saying this means SPY is going down tomorrow, or it's going down the next day, or it's going down after FOMC, or Microsoft earnings going to rip the bed and shit right in your mouth. I'm just saying you got to be freaking patient. If you're looking to buy stuff and just hold it, you got to be a little bit more patient. If you're looking at, well, I won't say that. If you're looking to go into like long dated calls on the S&P 500, leverage with time. If you're not just like buying AMD and being like, well, 20 years from now, I'm sure that'll go up. If you're not doing that, then you have to be patient on the S&P 500. You have to be patient. You have to wait until we get that higher high confirmation at 410. We got to break above 410. And then that can all just be nullified if we just dump down and go below 350. If we get like that black swan event, that can be completely nullified. So you have to be patient. You got to get that break above that and a retest of 410 and then continuation. So you get your higher high combined with your higher low, continuation to the upside. That is what you have to see before you are fully bullish on the stock market. And then with that golden cross to the upside, that would help. But hey, we could get exactly what we got back in 2001, where these lines just kiss each other and we dump. And if you look at these rallies, I mean, it's been like perfect. I mean, we go from like 480, 460, we top out, 460 over here. Then 450, we top out. Down here at 430, we top out. Down here at about almost 420. And then we go back up to 430. So this is our bull trap. Hey, we got a higher high. We rallied higher. But did you wait for confirmation of that, or did you just buy long calls? Because if you just buy long calls up here, you got completely destroyed because you didn't wait for the confirmation pullback with a higher low. You didn't wait. You were impatient. The market took your money. They bought a pack of cigarettes and laughed as they smoked them all with your money. And then what's the next rally? Oh, we rallied to 410. So you can see we're going from like 430 to 420 to 410. Now we're at 400. We're struggling to break 400. Yeah, just a little perspective. I'm not bearish. I'm also not bullish yet. I'll get bullish when I need to be bullish. I'll get bearish when the market, when it looks like the trend flips and we're going to go back down. Right now, the trend is clearly to the upside. The very short-term trend, like this week's trend, is to the upside because you can see the green days. So I just have to talk about these things because I feel like people's they can cloud their judgment. They can just be like, God, we just missed our chance. They get greedy. It's greed. It's FOMO. And no, these are natural human emotions. You're never going to not feel greed. You're never going to not feel FOMO. You can only control how you react to those feelings. And that is very important. Something I've learned a lot this past year because I've just gotten completely destroyed by some of these insane FOMO rallies we've had. And I just look back at 2000 and I'm like, man, people were definitely doing the exact same thing back in 2000. And how many people back here in 2000 saw this bottom, they saw the rip, and then they were still being bearish up here. Meanwhile, people were laughing at them. They were like, you missed out on your chance to buy. You should have fucking bought. And then they get the next one. And then those people who didn't buy it, who were getting laughed at, they were like, finally, I get another chance. 9/11. This has to be the bottom. I'll get another chance to buy. And then it rips up. And then those people who didn't buy, they were getting laughed at by the bulls. They were like, you didn't fucking buy. The market, it's rallied 20%. You didn't buy. That was the bottom, dude. How could it get worse than a fucking 2 airplanes flying into big buildings in New York City? How could it get worse than that? And they were laughing at him. And then what happens? Oh no, we get another bottom. So this is what I'm talking about. This was over the span of 2 years. You know, you got to zoom out. 1 year is just a blink of an eye in the stock market. All right. Anyways, guys, I got to ask one thing at the end of this video. If you watch the entire thing, I really appreciate you. I know I rambled on a lot, but I have to do these little videos to keep myself sane because sometimes I know I can feel my internal what the fuck is that? Pendulum. I can feel the internal pendulum. I can feel it going too high to the bullish side. When I need to have it centered, you have to be centered. You can get up to the bullish side when things are obviously bullish. Things are not obviously bullish for the long term right now. Not yet, anyways. I mean, long term, yeah. 10 years from now, S&P will be back. But I got to make these videos to kind of give myself a level head. Not being like, oh, now I'm going to make this video and go buy puts. Just saying, you have to be aware of what the stock market is capable of doing. It is so capable of just like giving you these fucking nuts rallies where you're just like, God, that was it. I missed it. And then you get another chance. But anyways, guys. And then when you don't get another chance is when the Fed comes out and they're like, hey, we're going to print trillions of dollars and drop interest rates to zero, which is what they did back here in 2009. It's what they did back in 2020. So those are bottoms where you're like, yeah, this is a fucking bottom. The Fed is pumping $8 trillion into the bond market. This is a bottom. You can say that. You cannot be like, oh, yeah, we bottomed out over here because maybe the Fed might pivot and maybe inflation is dead and maybe earnings are still going to be good and maybe we'll get the soft landing. Maybe. Come on, bro. Serious? Anyways, I appreciate y'all for watching. Drop a comment if you enjoyed. I appreciate that a lot. Drop a like. Share it to your mom and your dad and say, hey, Mom and Pa, you guys shouldn't retire for the next 5 years. No, I'm just kidding. Anyways, I'll catch you guys later. This is not financial advice. I'm not a financial advisor.